Good morning, good afternoon, depending on where you are in the world. On behalf of IETA, a very warm welcome to all. My name is Lisa Spafford. I'm Managing Director at IETA, based in our headquarters in Geneva, Switzerland. We're very much looking forward to bringing you today's event, looking at the voluntary carbon market, climate finance, and how we drive finance to where it is most needed. The voluntary carbon market has an essential role in reaching the goals of the Paris Agreement, as we have seen with the tremendous accelerated growth of this market in 2020 and counting. At the same time, I mean, we're witnessing a surge of institutional investors and banks that have started to align activities with net zero and goals of the Paris Agreement. Finance is definitely critical to accelerating the transition to a low carbon, equitable, and climate resilient economy. This event is part of the London Climate Action Week and as well part of our IETA Live Market Series, which we're delighted to be co-hosting today with our colleagues at South Pole, Vera, and ECROA. And we really thank you for your precious support. Just a few housekeeping words, as we're over 600 registrations. As attendees, you're all muted. However, we encourage you to engage and participate through the questions function of your GoToWebinar control panel. Post any comments or questions you wish to share with our speakers. We'll be monitoring these and answer as many of them as possible. The event is being recorded, and together with the PowerPoints shown, we'll be posting these links on our IETA.org and ECROA websites shortly after the event. And with that, I promised I would keep it short. I would like to hand over to my colleague Antoine Diemertz, ECROA's director, who will share some introductory remarks. Antoine, over to you.
Thanks very much, Lisa. I'll keep it very brief as well, actually. Thanks everyone for joining today. I'm very pleased to have David Antonioli, CEO of Vera, to moderate this event, to see how we drive finance and help plug the various gaps that we have globally, as mentioned by Lisa. We'll welcome panelists from Climate Focus, from South Pole, from BNB Advisory, and Wildlife Works in a few minutes. But before I hand over to David Antonioli, we thought it'd be useful to set the scene with a presentation that highlights demand, supply, and price dynamics for voluntary carbon credits. And for this, we're really pleased to have Guy Turner, who is the founder and CEO of Trove Research, which is a specialist data and advisory firm, with us today. And Trove focuses on energy transition issues, corporate climate commitments, and carbon markets. Guy, probably many of you know him, has 2 decades of experience in carbon markets, acting as a consultant to governments, to corporates, and then founding New Energy Finance's carbon and commodity market analysis business in 2006, a business which is now Bloomberg New Energy Finance. And then prior to Trove Research, Guy led the strategy and financial analysis team at EDF Renewables, which is a division of EDF, and has worked as an economist for BP and the UK Green Investment Bank. And the reason we wanted to have Guy on the panel today is that earlier this month, Trove Research and the University College London have published an important study, which is an analysis of the long-term demand, supply, and price of carbon credits in the VCM, in the voluntary carbon market. And their analysis models demand from thousands of companies, over 5,000 companies, I believe, actually. And I know from Guy that it was hard work over several months together and to analyze the data. So we're very pleased to have you with us today for a presentation of this work. So thank you very much for being with us. And I think what I'll do now is I'll just bring up your slides on the screen and then directly hand over to you. So over to you, Guy.
Thanks, Antoine. Thanks for a very generous introduction. I have the unenviable task of collapsing 9 9 months of hard graft, as you said, with ourselves and University College London into a 10-minute presentation and 10 slides. So I will do my best. The report has been circulated. It's freely available on the website, on our website. So I will expect everybody on the call to have read the details, but so I haven't really got the time and space to go into much of the methodology behind it. But the reason why we, if you go on to the next slide, the reason why we undertook this work back in, started off in September last year, was to really shed a light on this very rapidly emerging market, which has obviously been around for well over a decade, but has now sort of ramped up with great interest through net zero and a lot of corporate activity. And we thought we needed more visibility. So the research aims were, this was funded by the Children's Investment Foundation, by the way, in the UK. Looking at the future models of demand, where will the supply come from? How much will it cost to provide that supply? And then finally, what are going to be the implications for the Paris architecture, particularly around the interactions of voluntary and compliance markets? So being able to use the research to sort of inform some of the policy debates. If you want to go to the next slide. I don't think I can animate. No, I can't. So very quickly, let me just have a quick spin through the demand side, supply side, pricing, and then to the policy recommendations. On the demand side, we have split the demand for voluntary carbon credits into 3 sections. We looked at economy-wide scope 1 and 2 emissions. We looked at demand from the Corsair International Aviation Scheme, and then finally the commitments that a number of European companies are making for their scope 3 emissions, i.e. the carbon included in their oil and gas products that they are selling. So if you go to the next slide, Antoine. On the economy-wide scope 1 and 2 emissions, we took 3 different approaches to trying to get a handle on the size of that, the future size of that market. The first one really was quite simple, but it extrapolated the last 5 years growth rates in carbon credit retirements, which are growing at about 19% per year, and scrolled those forwards for the next 2 and 3 decades on a low and a high scenario. I think one said that the annual rate of growth would reduce somewhat. If you put 19% compound annual average growth into a 30-year model, you get ridiculously large numbers at the end. So you can't continue that annual average growth rate. It has to decline over time. Otherwise, you might need another planet to cover all of those emission reductions. The second one was really a top-down global residual emissions approach, where we looked at the global emissions profile under a 2 degree and 1.5 degree pathway, because the net zero commitments are about offsetting the residual emissions after all abatement has been undertaken, and then making estimates on what the business proportion of that residual emission is, and then what potential proportions of that might be deemed to be offset through the voluntary market. These are guesstimates. There's not really a scientific basis for making those numbers. They are sort of conjecture and sort of scenarios rather than predictions. And if we take a sort of 7 billion ton residual emissions under 1.5 degree scenario by 2050, then a 10% reduction or offsetting of that would be about 1.1 billion, and a third would be about 3.3 billion tons in 2050. The final one, as Antoine mentioned, was actually looking at a bottom-up basis, which was modeling the net zero commitments from every company that has actually set a net zero commitment, and then modeling their individual emissions profiles over the next 30 years. And at the moment, there are about the scope 1 and 2 emissions from the companies that have set net zero commitments are about 4 billion tons. And those should be reduced over time, and the residual emissions by 2050 will be about 1.6 billion. So these give us some sort of different handles different approaches on the potential size of a future voluntary market in 2030, 40 and 50. Next one. The International Aviation Organization, the Corsair scheme, is a scheme where the emission targets are capped at 2019 levels now, I believe, and then it's all about what assumptions are made in terms of international growth of international aviation travel after the COVID pandemic. And there are different views on what kind of resumption of international air travel will occur. So we formed a low and a high scenario around that. And then for EU oil companies, we looked at the 6 major European oil companies. We didn't include any companies outside Europe, but we looked at BP, Shell, Total, Eni, and Equinor and Repsol, and took the assumption that they would be offsetting, they would be reducing their carbon intensity of their products and then offsetting the residual emissions by 2050, which is BP's commitment at the moment. And so they would fall in line with that commitment. And then a sort of low and a high scenario around those numbers, ranging between 300 and 600 million tons of offset per year by 2050. Sorry, no, those are average numbers over that period of time. So if you go to the next slide, Antoine. So putting all those 3 components together and the different methodologies that we use for scope 1 and 2 emissions, we come up with ranges of demand for 2030, 2040 and 2050. So today we have an annual demand of about 90 million tons a year, or in 2020 it's growing at about 20% a year, or it has been in recent years. We wait to see what this year turns out like. But potentially increasing tenfold by 2030, and then potentially up to a 30-fold increase by 2050. But you can see the ranges getting broader as you go forward in time. Clearly, the uncertainty is increasing as you go forward, and so one has to be sort of slightly mindful of the assumptions that are built into some of those longer-term forecasts. But the one that we look at most closely is the 2030 number, and that's sort of between a 5 and 10-fold increase in demand from today's level. Can we go to the next one? Then on the supply side, we took a very detailed approach to this using global land mapping tools, a range of satellite modeling applications, and we looked at 3 different technologies for the supply into the VCM. This isn't exhaustive. This is a selective group using nature-based solutions, forest restoration and avoided deforestation, carbon capture and storage, and BECCS, and one with and without BECCS, bioenergy, and then thirdly, renewable energy in least developed countries. So we didn't include some of the other technologies like cook stoves or energy efficiency, industrial gas, methane during this cut of the market. So it is underrepresented against those technologies, but the emphasis on nature-based solutions is probably it probably resonates with a lot of folk on this call. And then the inputs into the modeling there was very detailed global land cover maps, looking at the carbon uptake of land, split by country, unit cost calculations across the board, different modeling approaches to different sections of that model, 5 different land cover classes, different deforestation rates driven by an academically peer-reviewed population-driven model, and commodity price forecasts for each of the different commodities, 60 different commodities, price projections out to 2050, which gives us the opportunity cost of land. So if we want to prevent forests from being cut down, there is a genuine economic cost of doing that, given that there is revenue to be earned by people doing it at the moment. And there's a lot more detail underneath this, but it probably doesn't be good use of our time to go into all of those assumptions at the moment, and they are in the report if anyone wants to look at them. So next one. So the modeling included multiple data layers using satellite maps and peer-reviewed references, biomass stocks, capital and sheep densities around the world, deforestation rates were modeled, as I said, using a population-driven deforestation model. And then those are combined to form an opportunity cost layer at every 350 meters square plot of land that is non-agricultural at the moment. So the constraints that we put on the model were you can only use reforestation policies on land that is not currently being used for agricultural purposes. Can we go to the next one? And then we also built in a scenario in the model where we said, what would happen if there was policy additionality, an extreme interpretation of policy additionality? So what all the voluntary market projects that would be eligible for the voluntary market would have to be over and above the NDCs of countries. Clearly an extreme position, and I don't think many people on the call would see this as being at all desirable either. But really just to sort of put an extreme scenario out there. We looked at the contribution of land use AFLU-based projects to NDCs and then deducted that capacity from the supply curve in order to come up with a change scenario where they are sterilized and not accessible to the voluntary carbon market. Can we go to the next one? So the results, when you crunch that through all of the big computational computations, is a global supply curve where the horizontal axis is millions of tons of CO2 reduced per year on average between 2020 and 2050. And on the y-axis is dollars per ton of CO2 equivalent. And some of the highlights of the supply curves are the restoration potential up to $200 a ton is about 3 times that of red. Which suggests that there's more potential for reforesting land than there is to incrementally change the rate of deforestation that's being done at the moment. The contribution of CCS and renewable energy in least developed countries is actually comparatively small. The CCS component is partly driven by the time frame we're looking at in the model, which was the midpoint between 2020 and 2050, which by 2035 actually is quite difficult to really build out CCS. So a lot of the emphasis on CCS and removal technologies that's been talked about is likely to occur later on towards 2050 or beyond. And so we looked at all the projects that are in the pipeline, all the ones that could be developed within this time frame. And if you want to go to the next one. So the final sort of aha is so what's the price likely to be? So when we intersect our demand modeling with the supply modeling, the model is actually reasonably well calibrated today at about $10 a ton. But when we start to use up those low-hanging fruit, the demands shifts to the right and the intersects are at higher price points. And we see without any NDC adjustment in that extreme scenario, prices between $20 and $50 a ton by 2030. And with an NDC adjustment, so sterilizing, taking all of that supply out of the market that is currently land-based within NDCs, between $30 and $100 a ton. By 2050, demand increases and the cost of meeting that demand increases to $30 to $100 a ton. And finally, what's the sort of the takeaway from all this? What are the policy recommendations? What are the sort of commercial recommendations? Really, what we draw out is that if prices remain at their current suppressed levels, I think this raises questions over the quality of some of those projects and some of those credits. This is based on our fundamental modeling and sort of calibrating those the prices that are needed to make those sort of material changes to the structure of those economies. Secondly, there is a material benefit in using nature-based solutions. Protecting existing forests and restoring degraded land are justified economically because of their low cost potential relative to the other technologies. and clearly have additional benefits in terms of biodiversity and indigenous people and social benefits. And then finally, the impacts of corresponding adjustments through that piece of that scenario we ran have to be very carefully thought through. There are arguments clearly in the market for some kind of sort of policy additionality or accounting adjustment, but there is an economic cost to doing that, or there is a price impact of doing that, you know, those considerations should be borne in mind when sort of coming to some conclusions on policy measures like corresponding adjustment. And that is my very quick tour.
Thanks very much, Guy. You know, before I turn to David for the panel discussion, you know, thanks for the presentation, and it's been impressive. Congratulations for the report. We had a question from the audience, which maybe you could take right now before moving to the panel, which is, could you please elaborate on the meaning of NDC adjustment?
Yes, that is really the extreme scenario that we ran to look at the effect of removing land-based, nature-based solutions from the voluntary carbon market, and assuming that they would all be done under the NDCs of those host countries. So the only way a voluntary carbon market player could get access to a nature-based solution would be go beyond the commitments that the governments have already made on nature-based solutions. So a very extreme interpretation, but really sort of that was that scenario.
Right. Thanks very much. Thanks very much, Guy. Of course, we might come back to you after the panel for more questions on your presentation, on your study. But right now, I'm just going to turn right away to David Antonioli, who's CEO of Verra, for quick reactions. Hi, David. To this, and also to get us started with the panel. So over to you, David.
Great. Thank you very much, Antoine, IETA, for the invitation to moderate this panel. And thank you, Guy, for that very interesting presentation. I had one clarifying question, and maybe just a broader philosophical question, which the first one was, in the diagram where you show rates of deforestation, I noticed, if I remember correctly, that they all start to fall in 2030 across all countries. Is that a model assumption, and what's behind that? Is that not, are you assuming that basically governments are getting on top of deforestation and starting to implement policies and regulations to stop deforestation? That's why that curve falls. And if so, how is that different to what you just described relating to, you know, NDC adjustments related to land-based activities? That's my first question, maybe a clarification, but curious to hear your thoughts about that.
I knew nothing would get past you, David. That's a really insightful question. The reason why those rates of deforestation fall is because of the modeling technique that was used, which was this population-driven deforestation model, which is quite a widely used model in academia for looking at future deforestation rates. And the counterintuitive outcome of those models is that as population increases in a country, deforestation rates fall, which is counterintuitive. But statistically, there's a statistical relationship in that direction between population and deforestation rates. This is probably not the time to go into the basis of those models, but they are peer-reviewed and quite widely used in academic research on this subject. But it is an odd, counterintuitive conclusion. But as economies develop, they become less dependent, and if population is a function of development, they become less dependent on natural resources in their own country, and therefore they need less land, and you know, sort of the Kuznets curves sort of philosophy that as one moves into high levels of economic development, the demand on natural resources is less.
Mm-hmm. Gotcha. Interesting. Thank you. And maybe my other philosophical question is more about, you kind of started with this, and where is the supply coming from? And I hear a lot of people worried about, like, oh my God, we're going to have all this demand and we're not going to have enough supply. And I wonder how much we should be worried about that. In the end of the day, this is a market and there will be demand and there will be supply. And I did notice that the Task Force for Scaling Voluntary Markets is actually asking this new governance body to think about how it guarantees supply. And to me, it seems that that's a question that really shouldn't be put to the governance body, and that the governance body should focus on quality and not worry about supply. The supply will sort itself out if everything else is working properly. But I'd be curious to hear your thoughts on that.
I agree. That the world is a big place, and the carbon market in sector is very, very effective at finding opportunities, and it can be very creative. So we have taken a reasonably static view of this, but experience in this industry shows that there is more than enough demand supply out there. The question is what the appropriate cost and price will be, to genuinely change the trajectory. I guess what we're trying to do with this report is say there is supply out there. We cut the charts off on the Y and the X-axis just to sort of zone in on the shorter term. I mean, there's 55 billion tons of CO2 being created being emitted every year, CO2 equivalent. The carbon market today is 90 million tons. So the opportunities for reducing emissions are immense, and I think people shouldn't lose sight of that.
Great, thank you very much, Guy. Really appreciate that. We'll come back to you with some questions when we get some other speakers on board. But first, I'd like to invite Rebecca Self to join us on video. Rebecca is the Director of Sustainable Finance at South Pole. She was formerly the Chief Financial Officer of Sustainable Finance at HSBC Holdings. She has approximately 2 decades of senior leadership roles in the financial industry. And in her previous role, Rebecca was responsible for group-wide sustainable business financials, external ESG reporting, and investor relations, including the Task Force on Climate-Related Financial Disclosures. She's chaired the European Banking Federation Industry SDG Working Group, and of course brings all that expertise to South Pole and the carbon markets now. So Rebecca, please share with us your thoughts on where we go with this topic.
Thank you, and I'm delighted to be here today, and thank you to those listening for joining. And very much appreciate the introduction. For the purpose of today, I'll be speaking very much from a mainstream financial perspective and a practitioner perspective from some of my previous roles, and also the work I do today with financial institutions. And as a reminder, I work at South Pole, which is a project developer and also an environmental consultancy. And I lead our work with financial institutions, including net zero, greenhouse gas accounting for lending and investments and so on. So when I started thinking about this topic and the voluntary carbon markets, climate finance, driving finance where it's most needed, I was thinking in 3 parts. And I'll go through those. So the first was really thinking about where is this most needed. And there was a World Economic Forum paper from earlier this year, which said in order to meet the goals of the Paris Agreement, so 1.5 to 2 degrees warming and limiting, over $23 trillion of investment and spending is needed between now and 2030. And turning to COP later on this year in Glasgow, there are 4 main goals, and the third of those is around mobilising finance. And that includes developed economies and mainstream financial organisations with a target of $100 billion per annum by 2020 every year. And then a sort of final number to quote was I then started thinking, wow, these are some huge numbers, thinking about different asset classes. And just as an indication, the green bond asset class, where fixed income instruments are raised in the markets, and those go into green projects and greenly defined projects. That's around $300 billion of issuance per year today, or I should say year to date, as we stand today. But that's a fraction of the overall market size, which is around 100 trillion. So it's 2 to 3% of the overall fixed income market. So when I think about all these big numbers and where finance is most needed, I see lots of gaps. And historically, more or less every single asset class that I've looked at, there's a gap. And more spending, more finance is needed. So much more to go. So then secondly, I started thinking, okay, well, what's really needed to drive this finance? And then the third and final part, I'll talk about the voluntary carbon markets. So what's needed to drive this finance? Well, financial markets are famously short term. There's huge monetary values attached to nanoseconds, for example, with high frequency trading and so on. And patient capital, long-term capital, can be quite challenging to come across. And often investors will be investing, and companies investing, other people's money. It's not their own. And I can tell you from my own experience, you really choose and think through those decisions and those investment choices very carefully. You really wear those positions and really sort of guard them very closely. So to shift to longer term finance, more patient capital, what's needed? I thought in three main areas. The first being education. And for many CFOs, accountants, investment professionals, this is a really new topic. Climate change, sustainability, ESG, the climate science, the technicalities around it, of which there are many. So a large amount of education needed for many finance professionals in this topic. The second, which is linked, is transparency. And quite often when making investment choices, there's a discounted cash flow model that you're working through, looking at projected cash flows in the future, then looking at interest rates, currency mix, inflation, and these will become ever more important in future years, as we can see some of the projections from economists changing. And with that discounted cash flow model, speaking as an accountant, you then need to think through, where are the assumptions, where are the estimates, what's the reliable fact-based data that I can use to enable my choice. And then you can start looking at whether this investment is worthwhile, whether you choose to go in it, how much, and so on. So transparent, fact-based information is really important, including scope, the level of estimation, and any assumptions which are used. So that's the second area. And then the third and final area to drive finance is really collaboration. And there are many experts, including many people on this call, panelists, academics, research providers, consultants, companies, and so on and so on. Everyone is needed. And there'll be many different perspectives. And that diversity of thought and bringing all those different perspectives is really important in order to scale and to avoid homogenous decision-making groups. So I think that diversity of perspective, having an open mindset is really important, because as this develops, there will be areas that need to be worked through. There will be some failures. There will be some areas that don't quite appear as expected, and so on. So having this diversity of thought, being able to identify, anticipate the challenges, and then work through those challenges in an open, collaborative way and constructively is really important. And then finally, sort of a third part, applying this to the voluntary carbon markets, and again, three main thoughts. The first is they're established, they've been going, lots of providers to learn from, there's workshops available, trainings available, so certainly taking advantage of what's already established. The second, with regard to transparency and reflecting on accounting, international accounting standards started in 1973. They're still evolving, they still change. And I suspect this will be no different at all. In my experience, also with regulations, they continue to change and evolve. That's entirely normal and welcome. So I think being able to deal with this transparency and changing and evolution of standards is important. And then lastly, on the collaborative, we all have our role, contributing to consultations, providing feedback, where we see best practice in the voluntary carbon markets and credits and so on, celebrating that best practice, sharing that best practice, but also ensuring accountability where standards aren't met and perhaps things aren't as expected. So I think that's really important to emphasize: celebration of best practice, sharing those examples, and then calling out and making accountable, perhaps where that isn't in place. And just a final thought would be, I'm personally very optimistic. I'm having lots of conversations with finance professionals, all sorts of other companies about the carbon markets, other elements of carbon finance, climate finance at the moment. In short, progress, but a lot more to do. And I'll leave it there.
Great, thank you. Thank you, Rebecca. That was very helpful. And we're obviously really delighted to have you as part of the carbon market, because you bring that sustainability, that corporate finance perspective to the table. And I think it's just a good indicator that you're now in the carbon markets, that these things are growing, and that we're starting to apply these very sophisticated financial tools to the system. I do have a question, and reflecting back, to Guy's presentation, and how do we reconcile, the fact that, according to Guy, one of the great opportunities for reducing emissions is in the restoration space. And yet, restoration is really hard to make work from a carbon credit perspective, because you plant a tree today and you won't generate significant carbon until several years out. And you mentioned three things that you think that we need, right? Which was education, transparency, and collaboration. Are those enough? Is that going to really be able to convince the CFO of a large company to say, okay, I'm going to put money down now and wait 5, 10, even beyond that years to recover that in the sense of in the form of a carbon credit? Is that enough? Do we need to do more?
I think it's a good starting point. And for some it will be enough, for others not. And I think this patience and timing piece is really critical. And so for me, I think these are the building blocks. I think there's always more that can be done. So verification being another example, while there's this lag. So put very simply, nature-based solutions while they're being developed. I think it's really that transparency. So it's being upfront about the time lag that might take place, upfront about loss or potential risks, credit risks as well that take place, and really having regular progress reporting along the way as well. So that's from a project side, but then the financial capital has its role to play, to be patient and to wait as these projects are being developed. So it comes a bit from both sides. But I think they're, put in a short way, I think it's important building blocks.
Fantastic. Thank you very much. Really appreciate your intervention. I want to bring Anna Lehmann on. Please join us via video. Anna joined WildlifeWorks Carbon in 2019 as a global climate policy director, and she works at WildlifeWorks Carbon on creating a level playing field for community-centered private forest conservation investments. She has been involved in the UN's carbon market mechanisms, both CDM and JI, as well as the EU emissions trading scheme and the voluntary market from the very beginning. Anna is a trained organic farmer and microeconomist and worked for international aid programs prior to moving into carbon markets. And she brings a very unique perspective to this debate, obviously with a view and lots of expertise on RED and RED+. So Anna, over to you, please.
Thank you, David, and hello, everybody. Yeah, great to be here. And yeah, really pleased. It's been, it feels like we've been talking for 20 years, but the discussion sort of moves on. And I'd really like to comment. I think Guy, brilliant research. It's so important to look at fundamentals and take a step back here and see where we want to go, right? Moving this market from 90 million where we are now to, whoa, I don't even want to put a number in my mouth. They're so big, I can't imagine them. Obviously, quality has a price, so we're always happy to take higher prices, but from an organization that has really boots on the ground, and I've been working on project development for those 20 years. Higher prices are not really the silver bullet for us to assure delivery of the supply, of the quality supply at the scale that we want to see. There's two more elements that are at least as important to us that I'd like to speak about. One is still the removal of structural barriers to investments in host countries is still one of the biggest barriers here. And I'm just bringing out two examples, one from the renewable energy space. In lots of developing countries, especially least developing countries, it's actually not that straightforward to get a power purchase agreement, a PPA for renewable energy investment. However, without the PPA, it's really impossible to raise project finance, right? So those projects are in a catch-22 position still today, have been for 20 years, very, very hard. Similar analogy from the REDD+ space, avoided deforestation space. What project developers need, what communities need, if they want to, certain communities in many parts, in many countries around the world have land rights or, well, or sometimes not. I mean, obviously land rights, that's a debated issue, but there are community projects out there, and they are intending to develop carbon projects. What they need is a FREL allocation, the so-called forest reference emission level. They need to have that allocated in order to raise project finance again. That's their form of the product they sell to the market. And the regulation and the guidelines from governments and how to do that, to get a maximum mitigation potential assigned to a specific area under the control of a project developer, those regulations are just not there yet. We're still operating in this very gray space, massive investment barrier. And the second one that's as dear to us as the previous one really is price transparency and profit sharing. Guy, I think you've been around, right? 2005, 2006, when European allowances jumped up to 30 euros or higher, right? So the height of the carbon market, but who actually benefited from that hype, right? Who actually participated in the upside of that market? Institutional investors mostly, and intermediaries, brokers probably. Certainly not the ones actually developing the projects on the ground, and least the communities. So if we actually wanting to use the voluntary carbon market in support of the SDG targets and support of the climate emergency that we're facing, really inducing structural change, we need system change. This is what people are asking for, and the voluntary carbon market can, be another element into that direction, another step forwards into that right direction. But we need to really assure that we're not just extracting another resource from the global south, and that those that are producing the emission reductions are also benefiting from the market upside. So price transparency and profit sharing agreement are absolutely critical for us moving forward. And then if I may, just to comment on your conclusion, the first conclusion of your study, I would say this sounds to me actually more as an assumption. I'd be quite careful to call this a conclusion. Low prices don't always equal bad quality. They don't always equal low additionality. I've not seen evidence around that, but happy to be educated. But there is a lot of projects out there that have had difficulties to sell for other reasons. Good quality projects, but they were in geographies that were, just of less interest or had experienced less demand, and also, I mean, just looking back historically where we came from is really important to keep in mind. We have the supply and demand imbalance has, I believe, mostly been due to a lack of demand from our side, so lack of regulation for the emitting sector, but also overall lack of demand supply imbalances. So those points in mind, really, removal of structural barriers, price transparency, profit sharing, and having taken a really granular look of what are, quality projects and what are quality criteria in light of the Paris agreements, because the NDCs, as we know, they are under ratcheting up mechanisms in the future. They are certainly going to increase in ambition over time. We are literally, determining additionality in such context where regulation is evolving, as Rebecca put it, is really hard. And it does often require also a subnational look, a regional perspective at circumstances within countries. It's not always that straightforward. And, David, you mentioned the Carney task force and the conversation in those working groups. And we I think we seem to fall back on to, using the Kyoto Protocol and the 3 ways we have to prove additionality under the Kyoto Protocol. We kind of tend to fall back to that. But is that really fit for purpose still in the Paris Agreement, where we're basically chasing, higher ambition all the time? However, what's expressed in the NDC is not necessarily supported through regulation or investment plans in the host country. So, again, I loved Rebecca's points. I think they're absolutely critical. Education, transparency, fact-based information, and collaboration, absolutely key as well to move forwards in developing sector roadmaps that allow, both national governments to develop to bring their investments to market, and as well as stimulating private sector investments through the voluntary market, and for that to go hand in hand. There's a lot of voices out there that claim authority across the field, but it's extremely complex. And getting us all into a room and getting the best developers into the room and looking at the science and the data that's underneath it is absolutely key. And those forums, we don't see enough of those at the moment. There's a lot of people with a lot of opinions, but let's get the experts in a room here and start talking and start opening books and speak frankly about what is quality and how can you measure it and how can you assure it. At Wildlife Works, we certainly are we're working in that spirit. We're speaking to our collaborators, our competitors, but they are collaborators for us in most of the countries, because we're facing investment barriers here that are way too big for any one of us to take on by themselves.
Great. Thank you, Anna. That was, oh, sorry, are you done?
Yes, thank you.
Great. Good. Thank you very much. That was very insightful. I do have a question, maybe a bit of a provocative question. I liked your point about price transparency and profit sharing. Is that something that should be required for all transactions, or is that something that we should just let some individuals lay out very clearly and let the market decide which they prefer?
Well, so it sounds like a philosophical question, but let me put this here, really looking at it from again, boots on the ground perspective. In our experience at Wildlife Works for avoided deforestation projects, but I say the same for renewable energy, where I worked before. Price transparency for those that actually are delivering the emission reduction, that are reducing the emissions or stopping emissions right now, is absolutely key to buy in into the whole, into the project, but also to assure permanence and continued investment over time. And I think there's this market has suffered from lack of credibility on various fronts, also in those communities where they sometimes they don't know the buyer, they don't know the prices at which they're being sold, transacted and traded. Just really turning this into a more transparent market, and that's similar to the energy market here as well, right? Transparency on the level of levelized cost of electricity, and actually where the margins occur. I remember that I'm German, which is why I've got a bit of a hangover for everybody who's into football. I'm looking at Guy a bit angry today, but sorry for that. But so the electricity market in Germany, where we had a lot of renewable energy capacity added, that actually really needed this price transparency for those new capacity to come on board and for new financial products to come on board as well. I believe it's fundamental.
Great, thank you very much. Really appreciate your intervention. I'm going to invite Sandeep Roy Chaudhary to join us. Sandeep is a co-founder at V&V Advisory Services, a social enterprise working with communities and trying to address climate change. Sandeep has over 15 years of experience in the carbon markets and his work encompasses supporting over 100 NGOs and grassroots community groups across 11 countries in the South Asian region. He is currently working on restoring natural ecosystems through carbon-backed blended finance for afforestation, restoration, conservation, and regenerative agriculture. Quite the spread. Sandeep is a Salzburg Global Fellow and is the current co-chair of the International Carbon Reduction Alliance, ICRA. Sandeep, over to you to hear your thoughts on this.
Thanks, David. Anna kind of, laid it on perfectly. I think a lot of what I was going to say has been covered, so I'm not going to spend more time on that, but totally with you, Anna. I think transparency, the point about additionality, sorry, Guy, I just had to make that point again. I don't think price is an indication of additionality. A lot of us had to sell really cheap, and for someone to turn back at some point, and I'm talking about 2013, 14, I just had to do that because of the simple fact that the markets just wouldn't buy my credits. And the same credit today is worth 7 times that price. So if it is additional now, it was additional then, as far as I'm concerned. So that's, I think a lot of market observers make that mistake of the price versus additionality, which brings me to my second point about a lot of the development that is being done, project development, in fact, is being done on structured investments from now, especially on the nature-based space, or, we do that even in an energy access or a water space and so on and so forth. A lot of finance is drawn up front, which then leads me to this whole barrier thing, because that's something that the so-called regulatory framework is right now. For me, the voluntary markets did not need the regulatory framework to interfere, but right now that's happening. We were always a market that was independent of the regulatory framework that's been a country-to-country kind of a legal framework. But right now what's happening is there is a bit of murkiness around, and especially with what's happening in terms of structured investments, which is long-term investments. When I say investments, it's not necessarily a financial investment. It could be somebody just hedging their prices. For a net zero plan in 2040, I might be investing in something right now. So I don't need a financial ROI. I need those credits at a hedged price because I expect credit prices to go up. And that's the sell that we make for patient capital. Rather than patient capital, the sell being the IRR, is that you hedge your prices. Look, the prices are going to go up if you are playing in the spot markets. So you better own your own projects, or at least start structuring our projects or a portfolio in a way that you have a mix of these kind of projects. It needs very complex financial structuring, and this has become a barrier because this kind of complex structuring that we're doing currently is always somebody or the other has to raise issues of, will this credit be still valid 10 years later? Will this credit that we're doing, what are the risks involved? So some of the risks, all project developers have that risk, right? And we know that risk, we can communicate that risk. But specifically these regulatory risks, which are not in our hands at the host country levels, is becoming a massive barrier. We just lost out, and I'll give you an example for the sake of transparency. We just lost out on a water project with coastal communities, and there was a large investment coming in from an impact investor, and their legal team flagged adjustments as one of the risks. And they said, can we put it in the contract that you will get a provisional letter of adjustment? I cannot sign off on something like that because I don't know whether that's going to happen. And that would lead to basically, I don't know, there were about 200,000 people who are going to access clean water in a rural area of an LDC who will not do that because of certain, I wouldn't call them, I would rather just implore people to just educate themselves a bit more about project development before getting into or having an opinion about the carbon markets. And I use the word carbon markets. A lot of us, we don't play the markets, we play carbon finance. For us, it's finance. It's not the market so much. And I think a lot of us who operate in the project development space in the global south look at it that way. We have always looked at this as climate finance, as much as people tried to make it about the markets and margins and so on and so forth. We were looking at this just as, and if I may, at a very philosophical tone, climate justice. This was the concept of common but differentiated responsibilities, loss and damage. For the Paris purists, these are terms that exist in the Paris Agreement. And for me, this is the form of the private sector showing up when the governments don't, right? So we're still talking about that $100 billion a year climate finance. Where is that? It hasn't come. In a G9 meeting, they're still talking about it. I thought this was committed in 2009. So that's what I'm talking about. It's for well-meaning companies, individuals who understand these concepts to deploy money and at scale, which is what we need. So I think we need to take a step back. I mean, there are so many task forces, meetings, consultations going on. Where is the global south? I don't see that. These are the guys who are mostly going to be impacted by this, right? I mean, at the end of the day, you're taking off much deserved finance. And we haven't seen, NDCs apparently are sacrosanct. They will all be met according to a lot of these, it's a weird thought process. How will these countries, and the global south comprises of 150 countries with different NDCs, a lot of them are conditional. How are you going to, it's a very complex discussion. To simplify it with a 6-month consultation for me seems wrong and unjust, if I may, because you are essentially deciding for somebody else on whether they or he or should get the money or not, based on a very drawing room conversation. Have the conversation by all means. We respect dialogue, but also keep in mind the impact that these kind of conversations could have on markets, right? So that's, if you bring up ideas that are not practical, by all means discuss it, but do not get it onto the mainstream and make sweeping statements. There was a meeting I was attending the other day where somebody said all voluntary credits are non-additional. My first question was, how do you know that, right? Now, when somebody goes to a forum and says something like that, it builds a lot of mistrust in the markets. It's almost the markets came up yesterday. We have been dealing with problems of additionality baseline. Look, we are an evolving market. There are bad apples everywhere. Just because there's a stock market fraud doesn't mean everybody stops investing in the stock market, do they now? So there are bad apples. We need to scrutinize them. We need to weed them out. But the fact remains that this market has a fair level of integrity. And for us, and things like low prices, etc., when emission reductions happen, they're mostly additional. I can tell you that from experience. I've been in the markets for a while now. So the thing is, these kind of, all it needs is some education from the people who are actually practitioners of the projects before making policies that will in fact impact them the most. And the whole idea that we can internalize all emission reductions, in the developed world, first of all, it's really expensive. You could do magic with $40 a ton in any country in the global south compared to the United States. I can tell you that, right? Or Switzerland for that matter. So first of all, there is an element of climate justice there because the community is there. You're not just about talking about climate, you're about alleviating poverty, you're working with livelihoods, you're working with gender. Things like that matter in the climate space. While governments will do what they do, and NDCs are really high level policy. It has to happen, great, let's hold them accountable. But we should play our part in doing this. Right now, we have the markets, which is, I would say, at the best place that I have ever seen them. There are net zero pledges, there are corporates who are willing to finance projects, there are projects on the ground willing to take that finance, but somewhere in the middle we've build this entire I don't know what we are trying to build here, because I think we are losing sight of the end game. The end game is climate change, and the end game is climate justice for the vulnerable. And that's how I think we should look at it. We need to change this narrative. We can't be putting ideas out there without proper knowledge. And this goes also for all the skeptics around that I see within the press, for example. Please do your background, understand baselines, reference regions, etc., before going out there and just putting something on the project for sensational whatever, because at the end of the day, the project loses a lot of credibility with that. This is a perception-based market. We really need to be careful about what we are putting out there in terms of our comms. Yeah, I will leave it there, David, and happy to answer any questions, anything that you might have.
Wow, thank you, Sandeep. That was an incredibly powerful and compelling set of statements. It wasn't just one. You covered a lot of ground. I really appreciate you taking the time to kind of share all those thoughts with us, which I, quite frankly, don't hear that often. Certainly not as clearly as you've articulated. I do have just one question. You mentioned at the very beginning about how complex these structures are, right? And the financial complexities behind them, and that was it that you had one project that actually fell through because there was a requirement that you had to give a commitment to provide corresponding adjustments, or were you able to sort that out? I'm just curious to know whatever happened to that.
No, we weren't able to sort that out. We lost out on that. Of course, we're still out there looking for more investments into it because, look, complex structures. Why, David? Because that carbon finance was also tied to a municipal bond issuance. So there was repayment for the municipal bond issuance through the use of the carbon finance that would be made for the project. So there are really, really complex structures going around, which I don't think a lot of people realize. Everybody thinks there's a spot credit and it's sold every year on year. That world is actually gone as far as I'm concerned. I think in the future, a lot of it would be these kind of structured products. So yes, the lost out on that. Of course, we will manage, David. We do, but that does not mean that everybody will. Right, so we will manage navigating this piece. I mean, we will manage probably navigating even an adjustment piece. But the fact remains that that becomes a very unfair playing field, right? We are a fairly biggish company, we will manage. But others won't. Imagine a cooperative which is going for carbon finance and somebody tells them this is a requirement. It's impossible. They wouldn't even get a meeting with the Environment Ministry. Forget about getting a letter or anything from that sort. Voluntary markets were created exactly for that reason, David. We all saw the CDM days where go to countries like Tanzania, hasn't issued a letter of credit, letter of approval for how long now? So, things like that matter and this should be taken into account. So yes, a short answer to your question, we lost out on that project, yes.
Yeah, well, thank you. And that's a shame, but it's very telling of the current playing field and what happens when there are, considerations, requirements put on things which are very hard or in many cases practically impossible to meet. And I think, my guess is, as you said, the financing is changing significantly. I think this will tee up a good conversation amongst all of us, because it's not that you have a credit this year and you sell it and that's the model that you have going forward. My understanding is that, and that's maybe exactly why we're having folks like Rebecca join the carbon markets, that we're talking about complex financial transactions that are commitments essentially going out into the future. So if someone asked me today that I can give them a corresponding adjustment, there's no chance I can do that, and that money goes out the window or doesn't get invested in this. So those are very real, very concrete examples of the challenges we face, but also the considerations we need to take into account. Thank you. Let me invite our final panelist, Adrian Cortius. Adrian is a co-founder of Climate Focus, an advisory firm that has for many years brought some of the best thinking to the practice and implementation of climate action by both private actors and governments. Climate Focus recently teamed up with Transforma, South North, and the Indonesia Research Institute for Decarbonization on a deep dive to highlight supply-side perspectives, much of the same kinds of thinking that you're bringing to the table, Sandeep. So Adrian, please share with us your thoughts and we can then go into a deeper discussion amongst all of us. Thank you.
Very good. Hello, everyone. Yes, what is there to say after these excellent introductions? Very impressed by your words, Sandeep, and very taken also by the three points that Rebecca made first. And Anna made a very, very valid point on price transparency and price revenue sharing equity. Let me try to be brief and share a few of my thoughts on voluntary carbon markets. The word in itself alone, and that's what Sandeep just mentioned as well, we always talk about voluntary carbon markets. And further to that, we use words like carbon credits, trading, and offsetting. Consequently, I mean, just by these words alone, when talking about voluntary carbon markets, the main concern always seems to be what is happening with the carbon credits once they have been transacted. So the wording alone is demand side focused. We question, for instance, and that's what's happening in the public debate currently, we question, for instance, the claims that buyers of carbon credits issue on basis of their purchasing the carbon credits. And next, there's a lot of a debate on the validity of, for instance, a climate neutral or a net zero or whatever claim. This vocabulary blurs the view of what the money from voluntary carbon transactions is actually doing for the planet. And let's not underestimate, there is a very clear link between the debate that's going on and the potential of financing. In the end, the voluntary carbon markets is what they are, what the word says, it's voluntary. So it's also largely built upon trust. It is about what investors and what buyers of carbon credits voluntarily put to the table to contribute to what they want to contribute to combating climate change. When that trust is disputed, when that trust is undermined by a debate on, again, the corresponding adjustments, on accounting, on whatever they claim, then we are in dire straits and we miss a huge opportunity. Because the track record of what's happening on the supply side is actually quite impressive. I mean, based on the payments from selling carbon credits, landowners in Asia, in Africa, and Latin America are provided with an incentive for keeping forests standing. And project developers are getting the extra support that is needed to develop, for instance, develop and implement renewable energy projects in the poorest countries. And in due course, we discussed that, these payments could lead to massive restoration of eroded landscapes. Looking at voluntary carbon markets, by the virtue of their flexibility, these markets have been able and are able to fund reducing of emissions rapidly where they can be reduced rapidly. Think of that. There is no regulations, there's no government pledges here. This is just the market that works to finance emission reductions all across the planet. Voluntary carbon markets have the potential of mobilizing millions, billions, if not trillions of funding into reducing, avoiding, and later on capturing greenhouse gas emissions. And by doing so, voluntary carbon markets can indeed be instrumental in actually realizing NDCs, in scaling up countries' decarbonization ambitions, and in increasing our chances that we will keep global heating within safe limits. Given the time we have left to avert catastrophic climate change, this is a rare opportunity. And I think all of those involved in the debate on carbon markets, on voluntary carbon markets, should keep that in mind. Look at the opportunities. We have very little time left, and we should not just waste time and waste basically confidence and trust in a mechanism with such big potential. That means when it comes to optimizing and to scaling voluntary carbon markets, a key question must be, how do we make it work on the supply side? How do we take care that the funding actually reaches target and makes it happen? These are the central questions that, and I'll introduce you to the Vcm Global Dialogue. These are the central questions that the Vcm Global Dialogue aims to address. So the Vcm Global Dialogue is a recent initiative from partners from Asia, Africa, Latin America, and Climate Focus. My company is very proud to coordinate this initiative. In Asia, the initiative is coordinated by the Indonesian Research Institutes for Decarbonization, that's IRID. African voices are coordinated by South North, that's from South Africa, and we rely on our partner Transforma from Colombia in Latin America. Vera, we are very grateful for Vera to support the initiative. In the VCM Global Dialogue, we explore the perspectives of stakeholders on the supply side of voluntary carbon markets, and we identify what is actually needed to make these markets work there. Different perspectives include those of governments, yes, of project developers, of corporates, and in particular, those of REDD+ practitioners, being the largest, or at least one of the largest categories where supply is would be coming from. In addition, we explore the needs and the constraints of accounting, a subject that also in voluntary carbon markets is very unavoidable. These weeks, well, basically as we speak, extensive stakeholder consultations, extensive stakeholder dialogues are taking place across the globe. As a matter of fact, tomorrow we will have meetings in each of the continents. So in Africa, in Asia, and in May, that's European afternoon, in the South American morning, a first stakeholder consultation in South America. Further to these conversations, the VCM Global Dialogue is launching a consolidated position paper in September and will invite for comments through an online global consultation. So that's where all you listeners and viewers of this webinar come in. At COP26 in November, the VCM Global Dialogue is presenting its recommendations to make carbon markets work for the supply side of the market and focus on that part. How can we make it work? Probably at this point, it is a little early to draw conclusions from the ongoing consultations. We are about halfway. One remarkable thing, though, could be that global voluntary carbon markets could actually benefit a bit from more government involvement, which is a bit paradoxically. Traditionally, voluntary carbon markets have stayed quite clear from governments, solely focusing on business initiatives, and from there the flexibility. The role of governments in voluntary carbon markets, however, would not be so much that of regulators. Letters of approval, like Sandeep mentioned, can take and have taken ages to be produced. But where governments could play a role, they could have a pivotal function in taking care carbon finance, climate finance actually reaches the national priorities and make sure that voluntary carbon markets can reach the scale we need and contribute to keeping global heating within the limits that are still safe. David, I want to keep it here. Back to you.
Great. Thank you, Adrian. That's a very helpful and it's an interesting insight about that. I was going to ask you, and I think this is also a question for the rest of the panel. I'll invite anybody. I'll ask you, Adrian, first, but invite others to join if they have some thoughts on this. So we've had kind of walk through from very different perspectives on the voluntary markets. I think generally everybody's pretty, excited and gung-ho about what they can do. But one of the questions that we get all the time, and you kind of touched on this a little bit, Adrian, but doesn't this undermine ambition by countries? Or how do we make sure that voluntary action actually complements or adds to government action? I think there's a perception that voluntary markets are going to undermine ambition by many countries, and that they're actually going to be detrimental to our efforts to fight climate change. What do you say about that?
I find that a very toxic stigmatization. Let us be clear. NDCs are policy intentions. They're not laws, they're not financed, they're not anything. They are simply policy intentions, and we yet have to see whether they are actually implemented. So that is where climate finance through voluntary carbon markets can help. Even here in where I am in Europe, our countries are not able to keep to their NDCs, leave alone in any of the countries in Asia, in Africa, in Latin America. So I would rather say voluntary carbon markets can make sure NDCs are actually implemented, and when they do so, and governments see that they do so, then they can even be instrumental in taking on more higher ambitions and walk the extra mile. So only the mere suggestion that voluntary carbon market transactions could undermine emission reductions, I think that's no.
Okay. Any other thoughts from anybody? I see people nodding and smiling at your comments. And did you say toxic mischaracterization? Was that the word you used?
Absolutely toxic. Because the mere suggestion that, for instance, I'm a large company. I'm purchasing carbon credits for the sake of communicating to my shareholders, to my stakeholders, that I'm caring. And then the suggestion is that my money actually undermines, for instance, the Indian government's ambition to decarbonize. Then I don't pay that money anymore. This is a trust market. So any suggestion that my money is not well spent or actually is detrimental to reaching our goals makes that the money dries up immediately.
doesn't that, just a quick question, I mean, I do want to open it up to everybody, but fair enough, I get that. That's a good point. But doesn't that then depend that offsets are used responsibly as a way to complement internal activities that companies are doing? I think the other concern that people have about carbon credits is that companies, like the one you mentioned as an example, will just invest in projects and say, be done with it, right? That they won't do anything internally. What do you understand is being done in the market to address that? Because I think that there's a little bit of a divergence in the market. You've got the Science-Based Targets Initiative, which doesn't recognize carbon crediting at all. And yet many companies are actually taking on those targets, but going beyond and investing in projects. And I think that's the kind of behavior we want to promote. But how do we square that? Because you don't really have a mechanism that recognizes credits as a way to make claims, credible claims on the back of those additional investments. So anyway.
Well, first, I think it's a great thing that companies invest in reducing deforestation, in setting up renewable energy in poor countries. Great, great, great. The problem is, indeed, and you've pointed out that quite clearly, the problem is what they claim afterwards. And the claims can be quite bold. The claims can be, we purchase RED+ credits and now we are climate neutral, suggesting I've done everything I could and don't blame me and I'm the good guy. I think the problem is with the claim. The claim is where the audience takes offense. And probably, I mean, at this moment, we're in a situation where this is quickly tuned down. But over the past years, quite a bit of the criticism that the claims were a little too bold is right. Claiming that a company is climate neutral and then saying, okay, you can purchase as much of our product as you like because you don't hurt the planet, that is detrimental to the public perception. However, that problem on the side of the buyers is a problem on the side of the buyers. It's not a problem on the side of the supply. So if you have a problem on the side of the suppliers, if you have a problem on the side of the buyers, on the demand side, solve it there. Solve it where the problem lies. The problem lies in the exaggerated claims. Actually, at this moment, another initiative, VCMI, the VCM Integrity Initiative, is studying exactly this subject. So when you're purchasing carbon credits, what title can you derive from purchasing those? I think there we already see quite some diversity in different claims. And well, I wouldn't regret if large buyers would proudly say we are supporting avoiding deforestation rather than saying I am climate neutral, because I as a customer, I as a client, I have much more sympathy and I can think what it means when my airline says, or when my retailer says, my supermarket says, we contribute to, well, restoring forest. We contribute to taking care that there is renewable energy in Zambia, or what have you. I feel much more related to that than the bit controversial claim, we are climate neutral, because I can't understand why a retailer or why an airline company can be climate neutral in the first place. Simply from the perspective of us as consumers and understanding the claims that we get communicated.
Great, thank you. Anybody else have any input or thoughts on this? I see people nodding. Guy.
I'd just like to, Andrew, and I think you're Sandy, very, very sort of insightful characterization of the current situation. I'd just like to sort of respond to one of your comments about the Paris, the NDCs being policy aspirations. I think a lot of people would agree with you, but the people that would disagree with you would probably be the UN negotiators that want to try and distance themselves as much as possible from the concept of policy aspirations, where a country may or may not achieve it depending on this, that, and the other, and we'll do our best, and we'll give it our best shot, but we might not do it. I think the rhetoric that you see and the conversations in the UN process, these are hard targets. A country makes a commitment, we cannot afford to water them down, they have to be achieved. I agree, and I think most people would agree that the US is half the countries, developed countries included, are not on target to hit their 2030 targets. And Boris Johnson in the UK has made some incredibly bold statements, as is his wont, to without an awful lot of science behind it, economic thinking. And so I think the challenge that you characterize, and Sandeep, around the corresponding adjustments, the sort of the double claiming type thing, part of the blame as such, or the problem, probably lives in the UN box, and how people are thinking about whether these targets are aspirational. The whole conditionality of NDCs is based on the premise that the first NDC is a very hard target, fully funded, committed, and achievable. And the problem is in the real world. I agree with you that there is a lot of interpretation around that and uncertainty. And I think that is where the problem is, whether or not the voluntary market is displacing national ambition or not.
Yeah, thank you, Guy. So, I mean, Sandeep, Anna, and Rebecca, you guys as project developers are surely, faced with this question, right, with the NDCs and what they mean. Any reactions or thoughts to Guy's points?
I just had a quick reaction. Sorry, Rebecca, if I could, that was my. Is my voice echoing now?
A little bit.
Sure. So basically, I mean, on the NDC part that Guy mentioned, I think we need to make one thing very clear. The developed world meeting their NDCs is only 30% of the job done. If we don't take the other world along with us, this is a zero-sum game. So the fact remains that that's where voluntary action does come in. So even if you have all of the EU and the North American belt meeting their NDCs, and if the global south doesn't, we still have a problem in our hands. So the more we look at voluntary markets complementing meeting NDCs at all levels, rather than looking at it as an outside piece into the UN system, I mean, we have to be very careful about this. So that's internalizing reductions in your country is great, and civil society really loves that idea. But that's not going to solve our problem. So that's something that we really need to think about, because voluntary markets actually help the global south meet their NDCs, and probably the global north as well to a large extent in future. Who knows? That's how it should be looked at. Just that one point I had to make over there. Yeah, sorry. Over to you, Rebecca, if you had a comment.
Thank you. Rebecca?
Thank you. And perhaps a very quick, more holistic thought. I mean, there's enough finance and capital in the world today. Now, large amounts of it sit still within the financial economy and speculation and so on. There's also enough projects, companies, requirements needed to have that transition toward the low carbon economy that we all want to see. So the question is really, how do we bridge those two things? And when I think about it, this isn't an either or question. There are multiple ways. There's all sorts of toolkits and all sorts of mechanisms that can be used, of which the voluntary carbon markets are one, government another. So I think it's sort of really thinking through all those different levers, maximising them as much as possible. And I think two brief points. One was on hype. And typically when I sort of read many big, bold claims and some of the over hype in the market, be it by particular corporates, and we've probably each got our own favourite examples, sometimes even with the projects, there can be a bit of hype on occasion, some that I read. I always get nervous, and it's somehow that if it sounds too good to be true, it probably is. So I think on the overhype, moderating that, having more kind of rational claims which are very clearly stated with the estimates, with the assumptions, with the scope, I think that's really important in the immediate instance. And then the second instance is also on this systemic question. And really what we keep talking about is a lot of the systemic change that's needed, because put frankly, much of what we see today, be it the financial flows, transaction flows, lack of diversity, income inequalities, global south, global north, and so on, is a result of systemic issues. So I think there's a much longer term conversation to be had there.
Great, thank you, Rebecca. Anna, did you have any thoughts on this? I saw you were nodding. I'd like to hear your thoughts on this point. We're almost out of time, but I wanted to hear your thoughts on this. I know, Adrian, you've got some thoughts as well.
Great. Well, just to throw things in, you know, like bring in perspective here, and Guy, I think you said this also on your first page. You know, the current voluntary carbon market is 0.2% of global emissions. 0.2% of global emissions, right? How bad can it be? You know, even if we're still, you know, wiggling around and not, you know, dealing with uncertainties and certain calculations, how material is that really, right? And that just, we just must not forget this in the conversation around, you know, what are credible baselines, what's a credible project, but also, you know, for corresponding adjustments, of course, right? And let's just keep bear in mind, because, you know, I mean, it's great with all this talk, having lots of new players coming in, new companies coming in with their ambitions and you know, really good, you know, heart in the right places and wanting to do the right thing here. But you know, certain companies, they've got multiple times the emissions of other countries, right? I don't want to put any names out of the hat here, but you know, just for actual illustration purposes, we work in the DRC, right? Amazon, their emission is 20 times the emission of the DRC, right? 20 times. Now, not saying that they would, and Amazon's got a great decarbonization strategy. That really is just an example, right? But one could, you know, go with VW, right? 4 times the emissions of Colombia, and they want, if they would want corresponding adjustments, they probably don't. I don't know, really just picking this year, but without us actually showing how they use, you know, the offsets on their side, how it shows in the inventories of where the emissions occur, why do we have to go through all these, jump through all these loops that Sandeep mentioned, right? And, you know, educate the project development industry and the governments over there. This is really hard work, right, on that side, and increase ambition in those countries. How material will that be to bring in overall emissions down when we're not seeing actually the decoupling of profits from emissions growth? Right? I mean, this is really what we need to see here, right? Those corporates, yeah, decouple your emissions from your profit from your profit growth. That's really what we need to see to start with, right?
Thank you, Anna. Adrian, you had some comments. I'm going to pass over to you for your final comments, and then I'm going to wrap up because we're up on time. Please go ahead.
Yeah. Guy mentioned a gap, a difference between the reality of the UNFCCC negotiators and the real world. And I think we should be very, very happy that the voluntary carbon market is actually in the real world. And we should be very cautious to keep it there and just make it happen and get all the money to there where we can reduce emissions.
Great, thank you, Adrian. I mean, I think you gave me a good way to end this a very interesting discussion, which has covered a lot of ground. Thank you very much to all of you guys for your thoughts and your input. I think overall, as I think about what we've discussed today, you know, we started with some really strong analytical work underpinned by a lot of data and thought. And then we had some reactions from you guys on the ground, thinking about what this really means in terms of real work on the ground. Practically speaking, what does this all mean? And I think that kind of gets us to your final point there, Adrian, about, you know, keep it in the real world, right? The voluntary market is having an impact. It is helping us address climate change. And I think that the future is bright. We do need to make sure that, you know, everything continues to work, that we are, in our case at Vera, that we're certifying, you know, real projects that are adding real environmental value to the equation. But also, all of you guys, you've described some really interesting ideas, right? The discussion about price transparency and profit sharing, all of these things. And I think you mentioned, Rebecca, the fact that, you know, international accounting rules started, you know, really were agreed to in 1973, and they're still evolving. This is the case for this market as well. But in the course, we're actually demonstrating that it's having a lot of impact, and all of you guys have really spoken very compellingly about the impact that it's having. So I'm going to close with that. Thank you very much for all your interventions. Thank you, IETA, for having this session. And I'm really sorry we didn't get to any of the questions in the chat. but we did get into some interesting discussions. I hope it was interesting for everybody. This session will be on IETA's website. It's recorded if you want to look at it. Thank you very much. And again, to everybody, have a good rest of the day or evening, depending on where you are. Goodbye.
Thank you.
Thank you. Bye.
Hi, everybody. Thank
Thanks,
you.
everyone. Good session.